It's official! The Australian housing market is screwed up! How screwed up? Pretty much among the most in the developed world. I'm Biko Konstantinos, and that's what we're gonna talk about today. Please take a second to like this video, as that would help my content get suggested. And if you want to stay on top of the big picture for the housing market in 2023, consider subscribing to my channel. I'll keep you up to date on what's really going on. Now, why is the Australian housing market so screwed up? I think anyone living in Australia could tell you that there's something fundamentally wrong with the housing market. In 2019, before COVID, house prices were already extremely high compared to wages. But then what happened? COVID hit, government intervention, dropping rates to zero, putting a rocket under house prices. So we saw 30% rises due to crazy speculation. So that's 30% on top of already crazy expensive house prices. We know it's not right and it's not sustainable. But now we have an official International Monetary Fund report highlighting just how screwed up the Australian housing market is. So what's the housing price dynamics we're looking at? First, there was a pre-pandemic housing boom. For Australia, it wasn't just a decade of rises, it was more like 3 decades. From the 1990s to early 2000s, prices started to really accelerate in Australia, and we've only seen some very minimal declines during this entire period. So for many years leading up to COVID, house prices had been rising extremely strong. But even more worrying than the house price gains is just how much more house prices rose compared to the average wage. From the late 90s, early 2000s, house prices massively started to outperform wages. And just look at this widening gap from here to here. So crazily, Australian house prices were extremely overextended even before COVID. So then what happened? Many housing markets further strengthened during the pandemic. Now, Australian housing didn't just rise during the pandemic. House prices went absolutely ballistic. Across the entire country, house prices rose 25%. But in places like Brisbane and Adelaide, they rose 40%, which is really quite ludicrous. Why did this happen? Well, we had extreme government intervention ensuring that the housing market was propped up. Then we dropped interest rates to zero, while the central bank promised no rate rises until 2024. And now that we've already seen 8 interest rate rises, the RBA governor is sorry.
I'm sorry.
So prior to COVID, the Australian housing market was overextended, and then we poured massive fuel onto an already overheated market. But now the IMF report is suggesting we're in a post-pandemic phase of housing price deceleration with the risk of a crash. The report states that house prices have now become misaligned to their long-term averages. So they've charted the deviations for housing price to income and housing price to rent. And you can see Australia here has increased on housing prices to income and housing prices to rent, and that's compared to their long-term average. But as we saw earlier in this video, Australia's house prices have been massively outperforming income over many years. So the long-term average was already high, and now there's been a further deviation from that already high position. And that's why even though the deviation here is showing 4th on the list, Australia could be actually the worst considering how long house prices have outperformed pretty much everything else, including wages, rents, and inflation. Now, based on this misalignment of house prices, combined with interest rate rises, the report suggests significant risk of a correction to housing prices. So the report's saying that house prices are way out of whack, and we're most likely to see declines closer to the long-term averages or where they should be based on the fundamentals. But it also said that the countries with the higher amounts of mortgage debt are at greater risk of significant house price declines. And as we can see from this graphic, Australia's mortgage debt is through the roof. So if interest rates stay higher for longer or even continue to increase, Australian housing is at major risk of a collapse. But as I've discussed in previous videos, there's no way the government will allow this to happen because the strength of our entire economy is based on house prices staying strong. But one day, maybe the government just won't be able to prop up the market, and we're starting to see some little cracks form in the foundation. And if you liken the Australian housing market to a giant dam, eventually with enough cracks, one day we could be in big trouble. When will that be? I've got no idea, but I know that house prices can't continue to massively outperform wages for years on end without some sort of reckoning, because there's just too many people who won't be able to afford property and will find it hard to pay those higher rents, and they'll be pushed towards poverty, and the government will have to find some way to look after them, because you can't just throw a huge section of society out on the streets. How much of a problem is housing affordability? It's a huge problem. And I mean huge! This red line here shows median house prices in Australia, and based on this price here, it's showing that the average median home is now above 40% debt service to income ratio. And that's based on buying the median priced home on a 20% deposit and paying around the average current interest rate. So it means that a household is spending more than 40% of their disposable income towards paying their mortgage. And many experts consider that paying more than 30% of your disposable income towards the mortgage means that you're in mortgage stress. And when you start getting over 40%, it's considered quite critical, and you're more at risk of defaulting on your mortgage, especially if your other expenses are high. Now, the real risk is if interest rates continue to rise from here. Housing affordability is currently shocking for a household buying a median priced house with a 20% deposit at current interest rates. So just imagine if interest rates climb from here. That's where the real risk is for the Australian housing market. It'll make it extremely hard for people to purchase a home, but it's also going to make it extremely hard for households with a large mortgage. And that's what happens when you encourage larger and larger mortgages through ultra cheap debt. Governments think that's the best way to continually stimulate the economy, but there's huge risk in making people over leveraged or mortgaged up to the hilt. And that's why I think we're close to the peak in this interest rate hike cycle, because our housing market is just so leveraged, we just can't afford for interest rates to climb too high, because that could devastate the Australian housing market, and in doing so, devastate the entire economy. But you can't consistently prop up the housing market and ignore a large section of the community, over 1/3, who don't own property. Non-property owners will rise up and demand policy change. And I'm starting to see it all over social media. You can't continue to support housing policies that only really benefit property owners. And that's a major area that Australia is going to have to tackle. If governments continue to take no action on housing policy, then it's very likely that the parties with policies designed to improve housing affordability will see significantly improved votes going towards them. So governments can ignore taking real action to their peril. So this report highlights that Australian house prices are misaligned to what they should be based on housing affordability. And because of that, we're at major risk of a significant house price decline. But will that decline turn into a full-blown crash? Time will tell. But as we could see a global recession in 2023, it could be a very bumpy ride for the Australian housing market. I'm Biko Konstantinos.